When investors think about a uranium bull market, they often picture the price spike at the end of the cycle, the moment spot finally reacts, the moment equities surge, the moment the move becomes unmistakable. But the most important question for this cycle is not whether a spike will happen. It's why the next spike will move faster than the last one. This video looks directly at that question. The conditions that shaped the previous uranium cycle no longer exist. Utilities today have less flexibility. Inventories are thinner. The spot market is smaller, financial participants react earlier, and the entire sequence of equity revaluation unfolds more quickly. So rather than walking through the process one more time, this video focuses on the four forces that will compress this cycle and make the next repricing phase sharper and faster than the last. Point one is that utilities have less time and less flexibility than they did in the last cycle. In the mid-2000s, most utilities carried comfortable inventory cushions. They held strong contract coverage. They had multiple large mines coming online that could eventually grow into the gap. That allowed them to delay contracting. They could wait, debate, and push coverage decisions into later years. None of that is true today. Inventories are lower. Unfilled requirements are closer. The number of viable new mines is smaller, and the lead times for new productions are longer. When a utility recognizes a structural shortage today, it does not have the luxury of time. The contracting decision becomes immediate. It becomes defensive. It becomes a priority. This is the first reason the next spike will move faster. The recognition phase shortens. What once unfolded slowly as utilities gradually tightened their books will unfold far more quickly once they accept that future supply is constrained. For investors, this matters because the earliest signal in the cycle now appears sooner and with more intensity. Utilities will not wait for spot to move. They will move first. Point two is that the spot market is even thinner today than it was back in the last cycle. Back then, the spot market was already small, but it still carried more volume relative to utility needs and investor demand than it does now. Despite that, spot still moved violently when the term market tightened. Today, the available material in the spot is even smaller, with conversion and enrichment constraints pushing more players into the same barrels, and with financial entities holding more inventory than before, the cushion in spot has almost disappeared. Once the term market tightens, that thin spot supply will not absorb buying pressure. It will amplify it. This is the second reason the next spike will move faster. The same amount of buying pressure that created a gradual slope in the last cycle will create a sharper upward step in this one. For investors, this means the moment spot recognizes the shortage, it will move in bursts. It will not glide higher over multiple years the way we expect. The structure of the market no longer allows for that. Point three is that financial participants react earlier and with better information than they did in the last cycle. Investors in the mid-2000s largely waited for spot to move before stepping in. They did not track utility coverage. They did not analyze contracting patterns. They did not model long-term supply slippage the way they do today. That world has changed. Financial capital now monitors the uranium market with far greater precision. Funds track inventories, contracting volumes, production delays, and lead times. They understand the supply gap. They understand the absence of large new projects. They understand the fragility of the conversion and enrichment. So when utilities begin tightening term, financial participants will not wait for confirmation. They'll move ahead of spot. They'll front-run utilities rather than follow them. This is the third reason the next spike will move faster. Financial capital enters the sequence earlier than it once did, accelerating the entire reaction curve. For investors, this means the old timing playbook no longer works. Waiting for spot to confirm the move will leave you behind the cycle. Point four is that equities reprice in the same sequence as before, but with a shorter delay between each stage. Producers will move first when term prices rise. Developers will follow when the economics of their projects clear again. Explorers will surge last when the market accepts that new supply must come from discoveries. But this cycle has one major difference. The gaps between these moves will be much smaller. In the last cycle, uranium was a niche sector. Coverage was limited, the number of specialized funds was small, news traveled slowly. Today, the sector is tracked widely by institutions. The supply gap is well understood. Analysts monitor contracting trends, algorithms react to price signals immediately, and the industry has a larger audience of investors who recognize the cadence of a uranium cycle. This is the fourth reason the next spike will move faster. The equity chain compresses. Each stage reacts sooner because the shortage is clear and the communication of that shortage is faster. For investors, this means the window to position across the producer, developer, and explorer sequence is narrower than it was before. When you connect these four forces, the picture becomes clear. Utilities move earlier because they have less room to wait. Spot reacts more sharply because the market is thinner. Financial capital steps in sooner because it now understands the shortage, and equities reprice with less delay because the entire sector is tracked more closely. The last cycle had breathing room. This one does not. That is why the next price spike will move faster than the last. If you'd like to see how these accelerating forces fit together and how they reshape the timing of the next price break, download our white paper, Behind the Curve, Understanding When and How the Uranium Market Turns. It lays out the complete framework behind the recognition phase, the behavioral triggers, and the timing adjustments that define the coming move.